All right, today we're going to dive into the world of options trading. The goal here is pretty simple. We're going to break down the fundamentals of how these financial contracts actually work. Now, just a heads up, this is all purely for educational purposes, so you can really get a handle on the core concepts. So, let's get into it. At its very heart, this is all an option really is. It's a financial agreement that's built on two completely opposite points of view. One person is betting a stock's price will go up, and the other is betting it's going to go down. The option, that's just the tool that makes this bet possible. So here's how we're going to tackle this. We'll build it all up in 5 logical steps. First, we'll nail down what an option even is. Then we'll look at the 2 basic kinds, the 2 sides of every trade, the nuts and bolts of the contract itself. And finally, we'll get real about the risks involved. Okay, let's start at square one with a foundational concept. At its core, an option is just a contract that gives somebody a choice. The most important phrase here, the one to really remember, is the right but not the obligation. Think of it like this. You're basically paying for flexibility. The person who buys the option gets the choice to make a deal at a pre-agreed price down the road. But, and this is key, they can just walk away if it's not a good deal for them. They're not locked in. So that idea of choice leads us straight to the 2 basic flavors of options. You've got calls and you've got puts. Which one you'd use really just depends on one thing. Do you think a stock's price is going up or is it going down? It's a really simple split. If you're bullish, you think the stock is on its way up, you'd be interested in a call option. That gives you the right to buy the stock later at a price you hope will be a total bargain compared to the market. On the flip side, if you're bearish and you think the price is going to fall, you'd want a put option. That gives you the right to sell the stock later at a price you hope is way higher than what it'll actually be worth. Now, of course, every contract needs 2 parties. In the world of options, they're simply called the buyer and the seller, though you'll often hear the seller called the writer. As you're about to see, they have completely opposite roles, opposite motivations, and really, really different obligations. So here's the fundamental trade-off. The buyer pays a fee, which is called the premium, to get that choice we talked about. Their risk is capped. They can only lose the premium they paid, nothing more. The seller, on the other hand, collects that premium, but in exchange, they take on an obligation. They have to make good on their end of the deal if the buyer decides to use their right. So while the seller's potential gain is pretty small, just the premium they collected, their potential loss can be much, much bigger. Okay, so let's zoom in and look at the anatomy of the contract itself. Every single option is defined by 3 key pieces of information: the price, the cost, and the deadline. And these 3 things all work together. The strike price, that's the number the buyer and seller agree on for the potential transaction. The premium is simply the price of the contract. It's what the buyer pays the seller to get that right. And finally, the expiration date is the deadline. If the buyer doesn't exercise their right by this date, poof, the contract just vanishes. It's worthless. And that brings us to our final, and honestly maybe the most important section: the reality of risk. Because for an options buyer, just being right about where a stock is headed, well, that's often not enough to actually make a profit. Remember that premium the buyer had to pay up front? Well, that creates a hurdle. For the buyer to actually make any money, the stock doesn't just have to move in the right direction. It has to move enough to cover the cost of the contract in the first place. We call this the break-even point. Okay, let's walk through this example to make it crystal clear. Let's say you buy a call option. The strike price is $100, and you paid a $5 premium for it. Now, look at the chart. If the stock price drops to $90, you just let the option expire. Your loss is capped at that $5 premium you paid. Easy enough. Now, what if the stock ends up right at $100, right on the strike price? You still lose that $5 premium. It's not until the stock hits $105 that you finally break even, because that $5 gain in the stock price just pays you back for your initial cost. Only a price above $105 is actual profit for you. So knowing that you have this break-even hurdle to clear, what's the statistical reality for most people who buy options? Well, the data is pretty eye-opening. That's right, because the stock has to make a pretty big move in the right direction before that deadline. A huge majority of options just expire out of the money. That's the term for when it just doesn't make any financial sense to exercise them. And in all those cases, the buyer loses 100% of their premium. And there's another major force that's constantly working against the buyer: time decay. The technical term is theta. The best way to think about this is to imagine your option contract is a melting ice cube. Every single day that goes by, and yes, that includes weekends, a little piece of its value just disappears. Why? Because there's simply less time left for the stock to make that big move you need. So the big takeaway here is that for the buyer, the clock is always, always ticking against you. Time is a constant headwind, just draining your contract's value. But think about it from the seller's perspective. For them, time is their best friend. Every day that passes makes it more and more likely that the option they sold will expire worthless, which lets them keep that premium as pure profit. And this all leaves us with a final question to think about. We've seen that options can provide incredible tools for leverage, but when you factor in that break-even hurdle and the constant, crushing pressure of time decay, who really holds the statistical advantage here? Is it the buyer who's paying for a high-risk shot at a potentially massive reward, or is it the seller who's collecting a smaller, more probable profit in exchange for taking on that obligation? It's really the central tension of the entire options market. Thanks so much for joining this explainer.